Good to go. All right. Morning, everybody, or afternoon, everybody. Let's do the pledge. I pledge allegiance to the flag of the state of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Mr. Peterson, do you want to pray for us?
We need a lot of prayer. Bow our heads. Dear Lord, thank you for another beautiful day, for the great weather you give us, because not everybody gets snow. And I pray that we'll be safe in our driving. Thank you for all those that were able to make it today. Be with those that are not here, and those that are suffering from different kind of maladies and their family members are, and help heal them. Thank you for the opportunity of service that you give us every day, and the choices that we have in our freedom. Please help us travel back safely and bless us food to our bodies. Amen.
All right, let's.
Are you guys?
Honorable.
There you go.
Is this on?
Yes,
Yes.
it was.
Woo. I can't hear out of my right ear. Okay, hi, everybody. Got a relatively short list of announcements here to make. And I'll just kind of go around the room for anybody that has anything to say about any of them. First up, we got holiday shopping on this coming Saturday, December 7th, Cascade Meyer at 7:30. 7:30. And Don, want to add anything there, or?
Oh, we've got a large group of volunteers and they're all set for it. We have one day.
Great.
Long as Don shows up. He's gonna get a whole lot of stockings.
Following Saturday, December 14th is the holiday party, Blythefield Country Club, 6 p.m. I believe. Rob, is that right?
6 p.m. and we have 61 or so coming, so we've got a nice crowd. The only thing I feel like we're going to have the raffle and Ryan will do some shopping, but if you have something around the house, or if you have a corporate storeroom, you can feel free to bring additional raffle gifts, and we'll accept them and raffle them all off. So, and buy raffle tickets, because number one, you probably will win a prize, and number two, it'll help underwrite the cost of providing free meals for our members. Okay,
And it's all cash or check.
cash or check. Okay.
Bitcoin.
You have any?
Yeah, I think we're selling raffle tickets at the door there. I think Drew is probably just gonna bill those that bring a guest for their guests. Drew will.
I think that's what, if you're, I think services get built for that.
Yeah, I think that's
The
it.
free tickets, I'm not quite sure how that's gonna be handled. Kim's got, okay.
Just bring a lot of cash with you.
There's a lot of cash.
You'll get an email from the boss telling you about great tickets.
Okay.
From the boss. I'm just support staff.
Aren't we all? One meeting left this year after today, December 17th. I think John Rice isn't here, and Mark might know.
John Rice. Yeah.
Speaker, is that the detective?
It's Joe Koenig. He is a private investigator. Just got off the world speaking tour. He's written several books. So it's likely to be filled with interesting and tawdry details.
Right, so we got a interesting speaker the 17th, and then also the first meeting of next year, in January, is the chief of police, so.
And that'd be a good
be a
opportunity to bring a guest.
Yep.
Okay, Chief of Police Eric Lindstrom. He's still his first engagement speaking actually after he started. So January 7th. He's very interesting.
Yes. Any other, Kelly, is there a service project month of December? I didn't have one. Okay,
No, that's not the.
okay, kids shopping, holiday shopping. All right. Anybody else, announcements or items for the good of the club? Seeing nothing, I'll, hand it over to the tape twister.
I got nothing.
That was a test, make sure you still remember.
I know. Well, I got fined so hard last time that
Hello, everybody. Happy, belated Thanksgiving on this and, just a notice for our next meeting. It's the last meeting before Christmas. Red attire is expected and costly if not. Since we're talking costly, anybody want to pay me for a pen that they didn't wear? Everybody did good, oh, except our speaker.
It's a tradition.
Perfect. Also, we have Happy Bucks. And for all the people that have been gone.
I was in Florida for a month.
Okay.
There you go.
And I can get in there. I know I move around.
You ever watch this thing?
You twist really good on that. Did you get the rolling ones on purpose?
Yes.
And from Mark?
Happy to be back in freezing cold Michigan. Not really. Good to see everybody.
I've got a couple of Happy Bucks. First off, my kids came in for 4 days. Well, my daughter didn't make it, but my son and his family, who has the kids, came, and it was a great 4 or 5 days. They're busy. Every button in the house has been pushed, changed, and so forth, but that goes with it. But thankful, happy for that, and happy they made it back to Massachusetts yesterday with no problems. Actually, the streets, the roads were cleaned up pretty well, they said, so that was good because it looked like it could be a worse trip. So that's oh, then my other happy buck is that Michigan beat Ohio State. Which I didn't expect, but you know, that's the way it goes. So any other happy bucks or anybody? Anything else? Okay, I guess it's raffle time. Bob, if you'll take care of my tickets. We got this here. Okay. Give all this to Cheryl right now, so that's easy. And that.
Thank you.
Yeah, if you didn't get
Yeah,
your parking
parking
ticket,
ticket,
certified or whatever you want to call it.
yeah, there's a sticker mark, it goes right in the middle of that ticket, scans. Yep, exactly.
Okay. First tickets were $5. One full out. We won't make that fine selection there. Kelly, why don't you pull? Okay. We have number, last 4 digits, 4964.
Bob Younger.
Okay.
Hit me.
Bye to him.
Hit me.
Bad. Hard to be here today. 4935. Okay. Put this up here. Get it out of here.
Probably a touch short of $500 in there.
Ooh, that's low.
That makes not winning just that more meaningful.
I'll split with the Lions.
Okay, that you think that's gonna help you? I can't do it. I'm not really.
Can't you help me here a little bit?
Yeah. I think it's this one, I put it on the top.
Oh.
Okay, That's it for the tail twister. Take one of these and give that to Bob.
Got 5 extra minutes. So today's speaker, we had a vacancy and our own Shawn Eyestone stepped in to fill that. Shawn, of course, the attorney and owner of Eyestone Law Offices, I think, right? There's more than one. And so he's just chatting with us today about impacts of the election and state law changes upcoming, and tax law changes upcoming, I suppose. What else should I say about you? I read your profile this morning. Shawn's been to 49 of the 50 states. Can anybody guess the one that he hasn't been to? Alaska. Anyway, graduate, Western Michigan and Wayne State Law School. I'll turn it over to Shawn.
Need glasses, no. Last time I spoke to you, I didn't need glasses.
Get your
So I have more wisdom, I think, to share. Well, thank you all for, thank you, Kyle, for inviting me. Thank you all for enduring me. One more time, it's been probably 10 years since I have spoken to the club about lawyer type things, so we're gonna go over planning ahead for some of the changes in the law that happened and that are happening or we think are gonna happen. This is, what we do. I've been doing this now for 24 years. People think I'm great. Got a couple offices. Disclaimer, this is for discussion purposes. It's not legal advice, even if one or so of you are a client of mine, don't construe this as legal advice. It's just shooting the breeze. The only ground rules I have is I'd rather you not be on your phone while we're doing this, and don't hear any dirty laundry. So it's a discussion, but if you want to ask questions, that's fine. Just don't air your dirty laundry in front of these lovely people. They may think less of you if you do. Or more, I guess. So the primary reasons for estate planning, I'll go over that briefly. The main thing is to appoint somebody to manage your affairs or handle your affairs if you're not able to, but also to empower them to do that. And then the other part that people talk about a lot is to choose who you want your stuff to go to and how they get it after you're gone or after you die. So what type of affairs do we talk about? Healthcare is one. There really haven't been any big healthcare changes in the law, so I won't talk too much about that, but most people know you appoint a patient advocate. You've got a HIPAA authorization usually signed when you go into the doctor's office that says who can access your medical records. If you've got minor or disabled children, there's some planning involved with that. Who's going to care for them if you're not able to? If you're incapacitated, you go missing, pass away. We also talk about your finances, who's going to manage your finances for you if you're not around for disability reasons or other reasons, or you pass away. And then if you do pass away, funeral, burial, cremation, there's not been any changes in the law there either. So really, we're going to talk mostly a little bit about healthcare, patient advocate, caregiver, HIPAA. So you can appoint a caregiver to be the one who does the caregiving for you. There's some rules around that. So if you've got somebody where you're planning to be in that caregiver role, it's good to talk to your attorney to find out what the rules are for being compensated for that. There's different rules depending on what your ultimate goal is going to be, whether you're trying to not avoid taxes and have to worry about getting a pardon from your father who's president, or some other reason. You should talk to your attorney to make sure that you're in compliance. So you can give services as a gift, you can give free room and board without paying taxes. Going above and beyond that, you've got to pay taxes if you're the caregiver in most cases, and then report them as well. So for minor disabled children, we talk about who's going to care for your children, both in terms of, do you have a question? If you don't have a healthcare directive in place, generally what happens is if your family can get along, you know, if you've got a spouse, they'll look to your spouse. If you've got children that they can look to, a lot of times for emergency decisions, they'll do that. But in the absence of that or any clear designation, then there has to be a guardianship hearing at the probate court. So you have to go into court, get a guardian appointed to manage your affairs, just like you would if there was a minor child who didn't have a competent parent or living parent to care for them. And the way that you can handle that is through the patient advocate. And it's, and those work in most cases, because you name who you'd want to be your guardian as well. The patient advocate only kicks in if you're not able to make decisions for yourself. And then as far as the minor and the disabled children, who's going to take care of your children if there's a temporary absence? A lot of folks don't think of this. They always, you know, in their will, there's a guardian named for their minor children, but they don't think about what happens if I'm temporarily gone. And I came into the legal field in 2001, and there was a lot of people that, and I was in Detroit, so there were a lot of people that got stuck on either side of the border, separated from their children in Canada, and or Canadians that were stuck over here, they couldn't get back. So things like that, that you don't always anticipate that you could be separated from your children, or more recently with the pandemic, if somebody gets quarantined and somebody didn't. It's good to have something in place, or just, you know, you get stuck on tarmac somewhere and you need somebody to get your kid because you're on a plane. And then also for death and disability. And then, you know, having in special instructions. And then we also talk about who would manage your children's money, when do they get inheritances, and for what purposes. So those are conversations that we would have. And then just knowing how your young or disabled children are going to be protected after you're gone. If you don't know, you should have that discussion with your legal advisor. Then we also talk, oh, you have one more question.
Discuss what happens if you don't do that.
If you don't, then the court will get involved. So if you have a temporary absence, no one's there to claim the kids, and the police don't feel comfortable with leaving your kids with anybody in particular, your babysitter bolts after 24 hours, whatever the case may be, then police will usually turn the child over to CPS until they figure out what's going on with you. They can get a hold of you. But having something in writing where somebody can take over your kids during a temporary absence. And then if you're gone, meaning dead or incapacitated, can't care for your kids forever, then it's going to be a probate court proceeding, and different people have different priorities. So the children's parents would have the first priority, and then the children's grandparents would have equal priority. So if you've got a situation where there's 4 different grandparent households where, you know, grandparents have all remarried, and there's differing levels of involvement, but everybody wants to fight for the kids because they think that's what you'd want to do, then it could be a big litigation fight over who gets the kids. And on the other side of things, if you don't name anybody and nobody steps up, then it becomes a foster care situation. If none of your people think that they're qualified or didn't think you want them to do it, or they just can't. So in talking about, and this is one of the things that we do with estate planning, both for the people and for the finances, is to avoid probate. For finances, that would be power of attorney for most people. So your income, your assets, giving somebody power of attorney over that would allow them to have access to that information. So the biggest change in the law for Michigan this year is we now have a Michigan statutory power of attorney. That went into effect on July 1st of this year. So the law provides that if your power of attorney is in statutory form that is uniform across the board for financial institutions, then the financial institution has to accept it. Before, the powers of attorney was up to the discretion of the financial institution. And if it was too old or they had any questions, a lot of them were starting to push back in the last 10, 15 years and requiring more and more and more, even to the point where we would have to file a petition with the probate court to have them recognize that, yes, this power of attorney is still in place. So with the Michigan statutory power of attorney, that's supposed to go away. It's too new to know whether it has, but you may start seeing some more standardized power of attorney forms at banks and things. So you might be able to do some of that on your own. And then also the vehicle transfer on death. This is an area where we run into a lot of hiccups, I guess. When people pass away, if they have a vehicle, getting it transferred to who they want it to get transferred to. If the whole family gets along, it's pretty easy to send them down to the Secretary of State, have them sign the appropriate forms. But if you don't want your vehicle to go to your spouse or to your children, or if you want it to go to one child over another child, then it would have to go through a probate process to get transferred to that particular person, unless you use a vehicle transfer on death designation. So I don't know when exactly the Secretary of State started allowing vehicle transfers on death. It's been within the last couple of years, but it's through their guidelines. It's just an interpretation of the statute that really has nothing to do with transfers on death. But it's a written document that we would prepare, or your attorney could prepare. We notarize it, we make it look as official as possible. It's like a will, but it's not. And then you can designate who you'd want to have your vehicles to avoid probate on that. And for some people, they have a lot of vehicles, and it saves a whole lot of time and hassle. There's also legislation pending to make this statutory. So just like you have a TOD and the designation on your bank account, you could own your car. Rob Lally, TOD, Shawn Eyestone, if you wanted to leave his car to me.
Is that typically necessary with a married couple?
Not typically necessary with a married couple unless you go at the same time. So what we do is we have the beneficiary designation essentially for the vehicle. If I die, my vehicle goes to my spouse. If we're both dead, it goes to these kids, or it goes to the revocable trust. If they have a trust, there's some tax benefits to it going directly to the kids. So a lot of times we're going to use this as a tool to encourage the family to get along, so that they don't have to pay taxes and probate fees on that vehicle. And then a revocable trust is a way that a lot of people use to avoid probate. It's an entity separate from yourself. You create it, you are the trustee, then you name successor trustees to carry out your instructions. Without it, there's intestate succession that the probate court will use to have your assets go wherever the statute says they should go. And if you have a will, that's instructions to the probate court to carry out your wishes as best as they can with the information that you have in the will. And then, of course, beneficiary designation. So all of your accounts should have both primary and contingent beneficiary designations. When we do planning for people, we always ask them to gather them up. Apologize to the financial advisors in the room, because we keep pushing them back, and we need the confirmation. We need a piece of paper that has the designation on it. Financial advisors are pretty good about it. If you're dealing direct with some of the companies, we've had some trouble just with when they've merged, or a lot of times we don't even know why. We know there was a beneficiary designation at some point, because there had to be, and they just disappear. And then you've got to prove to them or to the court that there was a beneficiary designation. So having that on file somewhere, even if it's with your family members, with your important documents, just knowing that you have that information, then you've got another breadcrumb to help make sure your plan works when it's supposed to. And then another thing that we do is ladybird deeds, or deeds to your trust. So for real estate, trying to make sure that the real estate gets transferred in a way that avoids probate. Not too much has changed with that in the last few years, but I will go over some of the tax things that did change. So once you figured out what you want to do with all of your stuff, there's additional things that you can do with, we've already talked about avoiding probate. That's one thing that people like to do. Speeds things up. Asset protection. So there's different kinds of asset protection that can be done. The most common type is protection from predators for uninsured or underinsured exposure. So if you're an OBGYN or you like to drive really fast and you want to be insulated from the things you do, or if you get into a bunch of bar fights and you want to make sure nobody can come take your assets, whatever the case may be, it's good sometimes to have that asset protection trust in place. A recent example I have from a client who thought he had enough insurance, and the insurance agent told me he had enough insurance, was a situation where he rented properties out to college students. And the college students decided it would be a great idea to see how many people they could get to fit on that deck. So the deck that was off the ground on the back of the property collapsed, and he has $1 million of coverage. However, the medical, so if these people had died, he'd have $1 million in coverage, but they got hurt. So he has coverage that is limited to $30,000 per incident and $5,000 per individual. So if you think of all these people crushing each other on the deck, that's not going to cut it. So he's now updating his insurance to manage that. But these kind of things, so you may think you have insurance for things, but unless you really break it down and go issue by issue with your agent, you've got a good agent then it can explain it to you. Having that backup for some people, if you've got a lot to lose, it doesn't cost too much to protect it. And then the other type of asset protection we do is to help people qualify for Medicaid or VA benefits. Again, if you're underinsured or uninsured for long-term care, there's ways of paying for this. If you're a married couple, there's a protected spousal amount, going through the process to make sure you're getting the maximum value for all of the assets that you've worked hard for. And I guess using the law as best as you can to hold on to as much as you can, or have your spouse hold on to as much as he or she can. And then minimizing taxes. So this is the part where there's a lot of stuff going on, which is why I was talking fast through a lot of the other stuff. So I have my career here from 2001. When I first started out, the estate tax exemption was $675,000. And this is a thing that they've liked to monkey around with over the last 24 years. So 2002 was $1 million, then it went up to $1.5 million, then 2 million, 3.5 million, then we didn't have one for a year. And then it went back up to 5 million, adjusted for inflation. And then in 2017, it kind of doubled, right? It's currently at 13.6 million adjusted for inflation. So the big drop off is, this was a 10-year deal. So January 1st, 2026, it's going to get readjusted down to 7 million. So for most people, they look at that like, well, that's a lot of money. But if you look at the time value of money, a lot of the clients that I have, they start spending less the older they get, and their investments tend to do really well. So if they double every 7.5 years, you can do the math to try to figure that out. And on top of that, if your parents are dying and leaving you assets that you don't know exactly what they are, it could become quite a problem. So right now, the tax brackets are 34% to 40% on the estate tax. And then 2026, it jumps up to 45%. So it's could be a pretty significant amount for some people. And again, this is over, if you're over that $7 million mark, that's where that starts to kick in. But most people are going to get hit by capital gains taxes. So when we talk about the estate tax, we always talk about capital gains taxes because you're going to balance one against the other. So there's a lot of aggressive planning you can do for estate taxes, but if the estate taxes aren't going to touch you, you don't really need to do that because you'd be better off by getting what's called a stepped up basis at the death of, I guess it's your death. So your family would get a stepped up basis. So when you buy something, your house, stocks, whatever, that is what they call your basis. That's the amount of money you've got into it and the gain you make on it over the years. So if you buy something for $100,000 and then you sell it for $200,000, that's $100,000 capital gain. And that's what these brackets are. So right now for a married couple, the capital gains taxes don't really hit you until you get over 600,000. So for a lot of people, that first $600,000, you want to make sure that you're not paying taxes on that, so you can keep that, and then just coordinating all of the assets and, you know, along the way, working with the financial advisor and the accountant to make sure that taxes are, you know, harvested or paid and offset against losses and all of the fun things that people like to talk about. You know, managing those capital gains, looking at the estate tax as well. So with the estate tax, there are, you know, we had a lot of ideas what was gonna happen if Harris had won. She wanted the estate taxes to come in at a much lower level. I don't believe that President Trump is gonna want the same thing. Because he has a lot more money than she did, and all of his friends have a lot more money, and he's the one that gave us the higher rates that we have. Or the higher exemption amounts that we have now, but he hasn't said anything about it either. So it's not on anybody's radar screen whether this is gonna drop off at the end of 2026 or not. So if you're in that realm of 7 million-ish, it might be worth looking at, talking to your advisor about, to make sure you're ready to go one way or the other. I have a hunch it's gonna get up to the wire on that one, because there's so many other things that are gonna happen in the first few days that we are been told about. So keeping that in mind, there's lots of ways that your advisors, financial advisors, accountants, attorneys can help you manage those tax rates. And then income taxes are the other part of the things that are dropping off. This is gonna affect all of us. So if you look here, the top rate is 37%, but it doesn't kick in until you're at 731,000. So these brackets are all gonna be condensed, and then the highest bracket's gonna be at 600,000 at 39.6%. And then you've got Michigan's taxes on that as well. Not a whole lot we do in the estate planning realm with income taxes and estate taxes, but if you're in a position where you're planning to sell a business, or you're thinking of getting out of your business, taking a buyout, the tax rates could affect you, and it would behoove you to work with your CPA to have him run some numbers, or her run some numbers, to figure out what the tax hit is. And then once you have that tax hit from the buyout or the sellout, or whatever the case may be, there are ways that we can help manage that tax hit. We can spread it out. Sometimes you can defer it through 1031 exchanges. There's lots of things that people can do to manage that income tax. So if you've got, you know, the double hit of selling out your business and having the rates go up, you might look at the timing of that as well, to just see if we do it this year and next year versus waiting to 2026 and 2027. Something to consider. You might keep some more money in your pocket.
Including substantial gifts to the Grand Rapids Lions Club Foundation.
Yes, you can make as substantial of a gift to the Grand Rapids Lions Club Foundation as you want. We can use charitable remainder trust to do that, because it's gonna be around forever. And that's another way that we can handle that. Yes.
Plus tax rates after someone passes away.
Yes, the trust tax rates, once the trust becomes irrevocable, it works kind of two different ways. For the income that gets distributed, that income is passed through to the beneficiaries, like with a K1, like you would in a partnership or a thing, things like that. But if it's an accumulation trust, then the tax rates get condensed. So the highest marginal tax rate, which you saw, is 37% going up to 39.6%. That kicks in, I believe it's right at around 12,500-ish in income. So if you looked at those other charts, it was 600,000, 700,000, about half of that for an individual. But for a trust, it's about 12,000. So anything over $12,000 in income, if it stays in the trust, gets taxed at that 40% rate. So again, working with your financial advisor and your accountant and your attorney to figure out, okay, what's the best way to grow this money? How can we grow it tax-free? Do you have a growth strategy for a portion of the assets and an income strategy for a portion of for the mark, for the amount that's going to be distributed? So it does require that you have good advisors and that you stay on top of this, and your savings and taxes will more than pay for the cost of the advisors being involved. Is that what you wanted me to speak to?
So, and that was, would you say there was also a hybrid version where the trust is not distributing all the same kind of beneficiaries, vertically back, so it's
Right.
set, gives you a tax rate.
Right, so that would be both. So if all of it's not being distributed out, and that's something that the trustee has to understand, that, you know, is this better to hold it in trust and keep 60% of it? Or 55 if you take into account Michigan's taxes on top of it, or distribute it out to the beneficiary and where they keep all of it if they're at a 0% tax rate, or a larger proportion of it if they're at a lower tax rate. So it does, excuse me, it requires that your trustee talk with the beneficiaries, talk with their advisors to make sure that, like Thad said, some of the income is going to come through for what's distributed, but if there's income that's realized on assets that are held in trust, it starts getting taxed at that highest rate, right around the $12,500 mark. So. And it can be both, like you said, it could be a hybrid of the two taxes where you're paying in the trust and outside of the trust.
Speak to, beneficiary that turns 18, who's inherits a very large sum of money, and distributing hundreds of thousands of dollars in income.
And that's gonna depend on the 18-year-old, but for most 18-year-olds, it's not a good idea to distribute it all out at once. And that, that's a different law, I guess I didn't talk about, is the Secure Act. So a lot of the clients that come to us have a lot of their wealth in retirement accounts, IRAs, 401ks, 403bs, all of those things. And it used to be you could stretch out the distributions for many, many years to come based on the life expectancy of the beneficiary. Now, unless it's your spouse, it's 10 years. So if you're leaving somebody $1 million, they've got to take out that $1 million within 10 years. And as they're taking it out, if your financial advisor is doing a good job, it's growing. So each year you're going to probably take out more, maybe 100 grand the first year, 110, 120. So if you're starting that at 18, that might not be the best thing to do either. And that's where you would have to look at having provisions in a trust. And again, going back to the charitable remainder trust as a way to spread that out over 20 years instead of 10. And at that point, it's going to depend on the numbers and your kids or your beneficiaries to find out what's going to work best for them. Most of the trusts out there are set up to be conduit trusts for retirement accounts, which meant it just passed through, and the required minimum distributions were the required minimum distributions that the statute set. Right now, the way that the required minimum distributions are for trust, it's based on your life expectancy for the first 9 years, and in the 10th year, it's all got to come out. So it could be a deferred thing where the trust is acting as a conduit like it's supposed to. And in the 10th year, right when your kids get launched in their career, starting to make a lot of money, they get a big tax hit for all of your deferred income as well. So looking at all of those things requires a team. I never do this on my own. I always work with a financial advisor and the accountant. And if there's not a financial advisor and accountant, I strongly urge the client to get one or both to make sure that everything is covered, and then to look at it from time to time. Because there's so many different taxes and gotchas in the law to stay on top of all of them. You know, you do one thing, it's like whack-a-mole, it causes another problem. So you take care of the spendthrift kid problem, now you got a 45, 50% income tax problem. And then another. Okay. The other area that I wanted to talk a little bit about was property taxes. So most of you know that your property taxes are capped based on Proposal A from 1994. And it's capped at the increase can be the lesser of 5% or inflation. So when we have really high inflationary years, above 5%, it gets capped at that 5%. When we have low inflationary years, it could be 1% or 0%. And sometimes it gets reassessed and reset to a lower amount like it did in like 2010, 2011. A lot of property values went down and then your taxes went down and now they're slowly going up. So a lot of people have these tax handcuffs because if they sell their house was worth 100,000 and now it's worth 6, they're gonna have to buy something else. And you buy a $600,000 house and you're paying taxes as though you have a $200,000 house, your taxes are gonna go up considerably. So a lot of people are stuck in place with that. But if you want to keep the property in the family, that's where we've got to do some additional thinking and planning, because you can keep the property taxes capped for transfers to certain family members and transfers for the benefit of certain family members. Otherwise, the transfer is uncapped and it resets, like I said, to 50% of the state equalized value. So the exemptions, so you can give it to your mother, father, brother, sister, son, daughter, adopted daughter, grandson, or granddaughter, and in-laws of the same ilk. So if you are looking, if you have a property on Lake Michigan and you'd like the property taxes to be capped, you're looking to adopt a son. I am willing to be adopted. So it's a very technical area of the law. A lot of care needs to be taken. There is guidelines from the state of Michigan that are 73 pages long. And you think in 73 pages long, they'd be able to cover all of the little ins and outs, but they don't. So working with an attorney to get through the process, which a lot of times the different tax assessors are going to have different interpretation of these guidelines. So knowing in advance how they're going to deal with it lets you know what you can do in advance to plan for. So do you need to transfer it to a trust? Do you transfer it to all of the people and then have them transferred into a trust? So a lot of the planning we did way back in the day, we used LLCs and family cottage LLCs, and there's really not a good tax reason to do that anymore. So the ones that we've done lately, we'll set up a cottage trust, and then the assets that fund it. So if you're going to have investments and things to keep the cottage going, that would be in an LLC, and then you can use the two to encourage everybody to get along and make the whole thing work. So and they keep adding to this long list of names. That was the point I wanted to make. It used to be your kids, and then it was your kids and your siblings and your parents, and now it's down to grandchildren. So there's lots of different creative ways that you can make this work. And if it gets somewhat complicated if there's members of your family who want to have this lake house because they're close, and then there's other family members or hunting land or farmland, any sort of appreciated property, even commercial property. Well, I guess not commercial property. That would get recapped. So for the family use type properties, that for non-commercial uses, that capping will carry on to the next generation. If care is taken, so if you've got different family members in different locales, you may have to do some creative estate planning to carve out the real estate that these people want to keep and have investments for the others, and having some complex balancing language sometimes when people want it to be perfectly equal, and it can get complicated. So if you are in those types of situations, work with your advisor, make sure they understand what you're trying to do. They can explain it to you, and then they can show you in the document how it's going to happen. That's not everybody. And now I have time for questions. Yes, sir.
So, going back to here. kids in college that are in another state or another city far away, if they live in Madison, don't have equipment.
Yeah.
They can't get any information about how their kids do it.
Right, yeah, and expanding on that, you're paying for college, you can't even get the grades, you can't even know how the kid's doing. You can't find out whether they got caught drinking in the dorm. Unless you've got documentation authorizing you to do that, and we do have a special plan that we've set up for, you know, kids 18 to 25-ish, kids without kids, essentially, where it's, you know, the will, power of attorney for finances and power of attorney for healthcare patient advocate designation, HIPAA authorization. The big thing with the powers of attorney, so with these statutory powers of attorney, they don't specifically address some of the things where these students are going to need you to have the authority. So I think it's FERPTA, the Federal Educational Privacy something Act, doesn't allow you to have access to your kids' records unless your power of attorney specifically gives you authorization to access the records. So for this college age students, we make sure we have all of that language in there about FERPTA. We talk about renting, not just rentors, because a lot of these forms, even the ones prepared by lawyers that we subscribe to, don't have provisions in there that make it clear that you can deal with a dorm, that you can deal with a care facility where they're not really renting, they've got a membership type hybrid interest like a lot of the retirement homes do, where you give them a whole bunch of money up front, so you don't really own it, but you're not really renter. So having language to cover all of those unique situations is paramount. Any other questions?
What about a living will?
So a living will in Michigan is, it's kind of, it means the opposite thing. It's the really how you want to die. So the living will is when you want somebody to pull the plug. So your agent under your patient advocate would have the ability to terminate life prolonging care only if you specifically give them the right to do that. And again, it's one of those things where unless you until it comes up, you know, it doesn't get added to the form. So we had one situation where a client wanted to turn off a pacemaker, or the surviving child, I think it was, wanted to turn off a pacemaker, but the standard form doesn't have turn off a pacemaker in there, so they didn't have any authority. So now we have that listed as well. So as the law changes, we try to keep the documents updated. There are some states that do allow for not euthanasia, but like euthanasia, you know, where you can, if you've got a diagnosis, kind of like you would for hospice, you're going to die within 6 months, and you've lived in the state for a certain amount of time, you can take life-ending drugs. So that's another thing to keep in mind, where, you know, if you've got that language in a written document, it could be a violation of Michigan law if you take somebody across state lines to do those sort of things. But there's backdoors around that where you can take them across state lines for other purposes. There's ways to get there, but I went beyond your question, but I'm not trying to put you down. But if you don't have those instructions written out, your family's not gonna know. And if you tell one family member who's in town, yes, don't do anything, take me behind the woodshed like they did in Old Yeller. The one who's out of town, who's not seeing your situation, they might not know what's going on, and you might not want to tell them because you don't want to worry them. But then you've got a dynamic of one child that's been through it, seen what you've been through, and knows that you're getting to the end, where the other one maybe doesn't see it and wants to fight for you. And then you have a new family dynamic that you didn't want.
Thanks, Sean, and I know you're a 20+ year lion and a past president, but maybe you don't have one of these.
I don't have that.
Okay, all right.
I did have one of the ones that exploded on my.
I had one of those too. Thanks, everybody. Next meeting, the 17th, but between now and then, holiday shopping on Saturday and holiday party on the following Saturday. Meeting adjourned. Bring your cash and your raffle prize to play.
Yeah.